Welcome back to the Digital Asset Report. Bitcoin is trading around $78,400 and Ethereum is around $2330. The tape has firmed up this week, but the bigger story is not the bounce. It's the build out of regulated market structure, especially in derivatives and stablecoin rails, where traditional finance is moving closer to products crypto traders have used offshore for years. We start today with the revelation that the US Navy seems to be running its own Bitcoin node. Take a listen.
We have a node on the Bitcoin network right now. We're not mining Bitcoin. We're using it to monitor, and we're doing a number of operational tests to secure and protect networks using the Bitcoin protocol.
In the same congressional hearing, Admiral Paparo stated that Bitcoin shows promise as a cybersecurity tool.
Our research into Bitcoin is as a computer science tool. It's the combination of cryptography, a blockchain, and a proof of work. And Bitcoin shows incredible potential as a computer science tool that through the proof of work protocols, it actually imposes more cost than just the algorithmic securing of networks and our ability to operate. And Bitcoin is a reality. It is a valuable computer science tool as a power projection. Outside of the economic formulation of it, it has got really important computer science applications for cybersecurity.
Also this week is the U.S. push to bring perpetual futures onshore. Reuters reported on April 22nd that crypto exchanges are racing to launch U.S. perpetual-style contracts ahead of an expected CFTC clarification. Kraken is buying Bitnomial for up to $550 million to access a U.S. perpetuals offering. Robinhood and Gemini are preparing their own plans. Perpetual futures volume reached $61.7 trillion in 2025, compared with $18.6 trillion in spot crypto trading. If that market moves inside the U.S. regulatory perimeter, it changes where leverage sits, how risk is supervised, and which firms get to own the most active part of digital asset trading. The message is straightforward. The crypto derivative stack is coming onshore. On the stablecoin front, the policy debate got sharper. The Bank for International Settlements warned on April 20th that stablecoins need coordinated global rules to avoid fragmentation, regulatory arbitrage, illicit finance risk, and pressure on monetary systems. The BIS also warned that stablecoins can trade more like exchange-traded products than money in moments of stress. That's a reminder that the global argument is no longer about whether stablecoins matter, it's about who controls the rails and under what rules. In Europe, that same story is moving from theory to clients. Societe Generale's crypto unit SG Force said this week that it now serves 15 crypto clients and expects corporate use of stablecoins to grow, especially for cash and collateral management. That's still early days and their volumes are small compared to Tether and Circle, but it shows that the same banks are no longer treating crypto firms only as a compliance problem. They're starting to treat them as customers and stablecoins as treasury infrastructure. Speaking of stablecoins, Kevin Warsh during his Senate testimony confirmed that the Federal Reserve has no right to issue a central bank digital currency.
Do you agree that the Federal Reserve has no legal right to issue a central bank digital currency?
Senator, I agree that they don't have the right, and I think it would be a bad policy choice.
So let me just put an exclamation mark on that. Under your chairmanship of the Federal Reserve, you will not have the Federal Reserve explore or any way move towards a central bank digital currency.
If it's within the power of the chairman of the Federal Reserve, I agree with that statement.
Warsh also stated that digital assets were already part of the fabric of the financial system. Take a listen.
Digital assets should be incorporated into our financial industry so Americans have new investment opportunities and consumer protections.
Senator, digital assets are already part of the fabric of our financial services industry in the United States, yes.
Elsewhere, Hong Kong is still trying to pull capital in to regulate crypto products. Chinese crypto mogul Li Lin is moving a trading system and investment team into Hong Kong-listed Bitfire Group to build a regulated Bitcoin-denominated asset management strategy called Alpha BTC. The target raise is more than 10,000 Bitcoin within a year. These moves show how institutional crypto exposure is being packaged outside of the United States, with Hong Kong trying to win share through listed vehicles and regulated structures. On the compliance front, this week also delivered a reminder that the hard edge risk is not going away. In London, the FCA raided 8 addresses tied to suspected illegal peer-to-peer crypto trading in its first joint operation of that kind with police and tax authorities. The industry also passed a milestone on Thursday, which marked 15 years since Satoshi's final email to Mike Hearn, as he said he was moving on to other things. Bitcoin has appreciated immensely since then and gone on to become somewhat of a financial marvel in the modern era. Put it together, and this week's signal is pretty clear. The US is moving toward regulated perpetual futures. Global officials are drawing harder lines around stablecoins. European banks are opening the door to crypto clients. Hong Kong is building new Bitcoin asset management rails, and regulators are following the money with precision. That's it for today. If you enjoyed this video, be sure to give us a like and follow along for more.